Welcome to the SafeSimpleSound podcast, where our approach to financial planning creates both and solutions for the contradictions families face. We believe you shouldn't have to choose between financial growth and peace of mind. Here, we build foundations that offer both. In today's episode, we're exploring a common challenge that we see pop up on investment statements across the country. It's the topic of our most recent blog post: Your investment return isn't what you think. We are discussing the green number paradox. Here is the situation. Have you ever logged into your investment account, looked at the performance summary, and seen a healthy green number? Maybe it says you're up 7 or 8% for the year. You feel a sense of accomplishment. You think, okay, we're on track. The plan is working. But then, later that same afternoon, you go to the grocery store. You fill your cart with the essentials: milk, eggs, maybe that specific coffee brand you love. You get to the register, and the total makes you wince. Or you pull into the gas station, and filling the tank feels like a significant financial event. This creates a frustrating contradiction. On one hand, the investment numbers on your screen are shouting, "My portfolio is growing." But on the other hand, your daily lived experience is whispering, "But everything costs so much more. Am I actually getting ahead?" This is a classic either-or dilemma that can create a false sense of security. It feels like you have to choose between trusting your investment statement or trusting your wallet. Through our Safe Simple Sound methodology, we know there is a better way. We believe in the principle of both and. The solution is to embrace the full picture. My portfolio is growing, and I understand how to measure its real growth after inflation to ensure my vision for the future is secure. In this episode, we are going to give you a simple tool to resolve this conflict. We are going to move beyond the headlines to the one number that truly matters for your financial foundation. Whether you are still accumulating wealth or are already navigating retirement, the insights we're sharing today will equip you with a clearer way to measure your progress. Let's begin by establishing our foundation. To understand why we feel this disconnect between our investment statements and the checkout line, we have to look at how returns are typically reported. When you log into your brokerage account or when you see headlines on financial news channels, the number you are seeing is almost always what we call the nominal return. Now, drawing from our CFC background at SafeSimpleSound, we know that the financial industry loves nominal returns. They are simple. They are clean. An 8% gain is an 8% gain. It is a satisfying number to look at. Our brains are actually wired to love this simplicity. When we see a big, bold number, we feel good. The financial media amplifies this. They trumpet market performance based on these nominal figures, creating a feedback loop that trains us to equate this single data point with success. However, we view reliance on the nominal return as a potential safety risk. It's not that the number is wrong, it's just incomplete. Think of it this way. Relying on your nominal return alone is like trying to navigate a ship using only your speedometer, without considering the ocean's current. If your speedometer says you are moving forward at 10 knots, you might feel like you're making great time. But if the ocean current is pushing against you at 4 knots, your actual progress toward your destination is much slower. The trustworthy tortoise of finance knows that speed doesn't matter if you aren't actually covering ground in the real world. So how do we measure the current? In finance, that current is inflation. To make this concept simple, let's leave the world of percentages and spreadsheets for a moment. We want to share a thought experiment that we use in our practice called the grocery store test. This is a way to visualize inflation's quiet impact without getting bogged down in complex economics. Imagine that last year you walked into your local supermarket. You pushed your cart down the aisles and filled it with a specific set of items. Let's say you grabbed a gallon of milk, a loaf of whole grain bread, a carton of eggs, a package of chicken breasts, and a bag of your favorite dark roast coffee. You get to the checkout, and the total comes to exactly $100. Now fast forward to today. A full year has passed. You walk into that same store, you push the same cart, you pick up the exact same items. The milk hasn't changed. The eggs are the same size. The coffee is the same brand. You get to the checkout, scan your items, and the total is 104. Nothing about the items in your cart changed, but the cost went up by 4%. That 4% difference? That is inflation. It is the invisible force that quietly reduces the amount of stuff each of your dollars can buy. In our Safe Simple Sound practice, we refer to this as your purchasing power. This is the critical concept. Inflation is the steady, silent current working against your financial ship. If you ignore it, you might be moving full steam ahead according to your nominal return, but you might actually be drifting backward in terms of what you can afford. This aligns with the principle of reality-based planning. We cannot just plan for the numbers on the screen. We must plan for the reality of the checkout line. Why does this matter so much? Because when we talk about being safe, the first S in S3, we aren't just talking about protecting your money from market crashes. We are talking about protecting your lifestyle. A plan isn't safe if it looks good on paper, but fails the grocery store test. From a Safe Simple Sound perspective, we want to provide the stability that comes from knowing the truth. And the truth is, your wealth isn't measured in dollars. It's measured in what those dollars can do for you and your family. Now, we are going to look at how to calculate the real number, the one that accounts for the current, and we'll walk through a hypothetical scenario to show you exactly how this plays out in a financial plan. In financial terms, this number is called your real return. It moves us from abstract numbers to concrete reality. Now I'm going to share the formula with you. It might sound a little technical for a moment, but stick with us. This is the sound part of Safe Simple Sound. It's the engineering that keeps the bridge standing. Many people try to do napkin math here. They take their 7% return, subtract 3% inflation, and say they made 4%. That is a good estimate, but through our Safe Simple Sound practice, we prefer precision because precision builds trust. The calculation for real return is 1 plus your nominal return divided by 1 plus the inflation rate minus 1. Let's break that down with an example from the blog post. Suppose your portfolio had a nominal return of 7% for the year. That's the green number on your screen. Most people would be very happy with that. During that same year, let's say the official rate of inflation, often measured by the Consumer Price Index or CPI, was 3%. If we apply the formula, you take 1.07 representing your growth, you divide it by 1.03 representing the cost of goods, and then you subtract the 1 to get the percentage. The result is 3.88%. That 3.88% is the number that matters. It represents the true increase in your ability to buy goods and services. Your wealth didn't just grow in dollars, it grew in what those dollars can do for you. To illustrate this principle in action, let me share a hypothetical scenario that illustrates how this distinction impacts a family's planning. While this story is created for educational purposes, it demonstrates patterns we see when families apply S3 thinking to their retirement planning. The characters and specific numbers are fictional, but the principles are very real. Let's imagine a fictional couple, the Harrisons. The Harrisons are in their early 60s, just a few years away from their target retirement date. They are diligent savers and check their accounts regularly. In our scenario, the Harrisons log in to check their year-end statement. They see that their conservative portfolio has returned 5% for the year. They feel a sense of relief. In their minds, 5% is a solid, safe number. They think, we made 5% so we can withdraw 4% to live on, and we're still growing our principal. However, the Harrisons are living through a period of higher inflation. In this fictional timeline, inflation is running at 4.5%. Without applying thinking, the Harrisons see a 5% gain. But let's apply the S3 lens. They have a 5% nominal return. They have 4.5% inflation. When we run the real return calculation, 1.05 divided by 1.045, we discover that their real return is actually just 0.48%. Not 5%, less than half of 1%. Here is where the safety risk lies. If the Harrisons proceed with their plan to withdraw 4% of their account to live on, thinking they earned 5%, they are actually depleting their purchasing power. They are eating into the seed corn without realizing it. They have more money in the account than they did last year, but they have less wealth because the cost of their lifestyle rose almost as fast as their account balance. While the story of the Harrisons is fictional, It demonstrates how our framework protects families from invisible risks. Through our Safe Simple Sound practice, we've observed patterns where families make spending decisions based on the nominal number, only to find themselves confused 5 years later when their budget feels tighter than ever. The Harrisons weren't doing anything wrong by traditional standards. They were investing, they were watching their accounts, but they were ignoring the current of inflation. If the Harrisons were applying S3 principles, they would look at that real return of 0.48% and realize they might need to adjust their strategy. Perhaps they need to look for assets with better inflation protection. Perhaps they need to adjust their withdrawal expectations for that specific year. This connects directly to the principle of vision first direction. Your financial goals aren't just about hitting a certain dollar amount in an account. They're about funding a vision for your life. A retirement filled with travel, the ability to support your family, or the freedom to pursue your passions. If your vision costs $100 today, it will cost $104 next year. If your investments don't keep up with that change, your vision is shrinking, even if your account balance is growing. This example shows why we are so passionate about this calculation. It provides the clarity required to make sound decisions. From a Safe Simple Sound perspective, knowing your real return provides the stability we look for. It prevents the nasty surprise of running out of purchasing power later in life. Whether you're facing this exact situation like the fictional Harrisons, or you are younger and just starting to build your nest egg, the principle remains the same. The only growth that counts is the growth that happens after the grocery store gets its share. As we begin to wrap up today's episode, let's bring this back to a place of empowerment. Understanding the difference between nominal and real returns is more than just a new math problem to solve. It's a profound shift in perspective. It allows you to move away from the noise of the market and toward the signal of your own life. This is about choosing confidence over headline hype. When you focus on real purchasing power, as we do in the S3 approach, you stop chasing the highest possible number at all costs. You stop panicking when the nominal number fluctuates, and you start asking the deeper question, is my purchasing power secure? We build sound, durable foundations designed to steadily grow your real wealth over time. It may not be as exciting as the latest market fad or a double-digit crypto spike, but like Shelby the trustworthy tortoise, it's the approach that wins the race for a secure and fulfilling life. To summarize what we've covered today, 1. The green number paradox. Nominal returns feel good but don't tell the whole story. 2. The grocery store test. Inflation is the invisible current eroding the value of your dollars. 3. The real return. By calculating 1 plus nominal, 1 plus inflation minus 1, you see your true progress. 4. Vision first direction. We plan for your life, not just your ledger. So here's your practical next step. This is something you can do today to build your capability. Before you check your portfolio's performance again, do a quick search for this month's inflation rate, the CPI. You can find this easily online. Then, look at your investment return for the past year. Run the calculation. Or, if you want to keep it simple for a quick check, just subtract the inflation rate from your return. It's not as precise as the full formula, but it gives you a much clearer picture than the nominal number alone. Ask yourself, how does this change the story my returns are telling me? This episode draws from our recent blog post titled, Your Investment Return Isn't What You Think, which you can find at SafeSimpleSound.com. We have the full formula written out there, along with more details on the grocery store test. Through our S3 approach development, we've created frameworks designed to help families navigate these contradictions. If today's insights on inflation and real returns resonate with your family's situation, we invite you to explore what financial planning could look like through our Safe Simple Sound practice. But remember, our goal is educational generosity. Whether you engage with our practice or not, you are now equipped with the capability to see past the headlines and understand the true value of your hard-earned money. That is a victory for your financial foundation. Thank you for listening to the Safe Simple Sound podcast. We look forward to helping you build a future that is safe, simple, and sound.